Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today's stock is Apple. We'll discuss, should we pass or should we play? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest.
And I'm Callie Cox, Senior Investment Strategist at Ally Invest.
All right, Callie. Well, I have a chart of the S&P 500 index. And last week we were talking about the markets being a little bit overextended relative to the 20-day moving average. We highlighted some periods where we had a little bit of a pullback when we got too far away from that moving average. On our chart, we're showing the 20-day moving average as the blue line here. What we've seen recently is just a little bit of consolidation in the marketplace. And I think in hindsight, you can kind of understand it in that the S&P 500 index has a third of the companies announcing this week. So obviously the S&P 500 index seems to have taken a little pause, trying to see what's going to go on with their earnings announcements. And in particular, a lot of the tech companies, or in particular the FANG stocks, Facebook, Apple, Amazon, Netflix, Google, are going to be announcing this week. Netflix started last week with the announcements. We have Google and we have Microsoft today, and we have Apple on Wednesday. So a lot going on in the markets. What do you see happening from your perspective, Callie?
Yeah, Brian. Well, you're exactly right. It's a big, big week for markets. And I know you like to talk technical, Brian, but let me throw some fundamentals in there. So it's been one of the bigger weeks we've seen in months for news. Earnings season is going strong. And like you mentioned, about a third of S&P 500 companies are reporting. And better yet, that's about 50. Those companies represent about 50% of the S&P's market cap. So that means that we have a lot of big hitters stepping up to the plate this week. Like you mentioned, most of the FANG stocks, which we'll touch on in a minute. And if that's not enough, the Fed is coming out with a policy decision tomorrow, and the first quarter GDP report comes out on Thursday. So are you having fun yet? Because I know I'm having fun. It's like a big week that market nerds live for. So I'm pretty excited for it. It is a lot to digest. And it comes at a time when the stock market is pretty quiet. I know you mentioned that we are a little overextended. That's been cut into a little bit. We've seen a little more support for the market, but we still are hovering near record highs. And the S&P hasn't dropped 1% or more since the middle of March. So we haven't seen a lot of action. I mean, the closest thing we've seen to some good market action was the 1 day's worth of volatility last week when the capital gains rate change news came out. And that was just a 90 basis point drop, which isn't very big in the grand scheme of things. Don't be fooled, though. The overall market is very quiet, but there's a lot going on underneath the surface. Small caps, or the Russell 2000, are back on the move, with the Russell 2000 up 5% in the past week. And we're looking at transportation stocks too. Transportation stocks like airlines and railroad stocks are up 3% in the past week, by the way. So lots of things moving underneath the surface, and definitely a lot of opportunity out there. So going back to this week, we expect earnings and the Fed to give us a little more clarity on what to expect in the future. And, honestly, this market could move off of a small Fed pivot or a FANG stock that catches investors off guard with earnings. It seems to be, kind of a shaky market. So expect the market to react to something. I wouldn't be surprised to see that. We'll just have to see how everything pans out. For what it's worth, let's talk the Fed. For what it's worth, I wouldn't be surprised to see Fed Chair Jay Powell tweak his messaging just a teeny tiny bit tomorrow in his press conference, just to acknowledge the fact that growth is rebounding. And if that happens, the market could definitely react to that because they watch Jay Powell like a hawk. Overall, just to sum things up, I feel like this market is shifting into a what could go wrong mindset from a what could go right mindset. It seems like over the past month, investors have really gravitated toward looking for what's hiding around the corner. whether it be a tax policy change like the capital gains headline, or a Fed pivot, or an inflation scare. So any negative headlines that come out could be met with some quick selling, again, like we saw last week, before people likely ultimately buy the dip, because there's still a lot of buying pressure in this market. And I'll note too that anxiety is healthy. This isn't necessarily a bad mindset for the market. You don't want to see a market that overlooks the risks, because that's called exuberance. And that could lead to a painful pullback if bad news comes across the tape when it's least expected. So sentiment, while optimistic, looks pretty healthy, especially with anxiety heating up in certain parts of the market. So, Brian, that's the rundown of what I'm seeing in markets. Let's talk about FANG stocks because I know you've been seeing some interesting trends in those options.
Yes, we've seen the VIX, the volatility index, just hang out below that 20% level. So it's not as exciting of a story recently with what's going on with the VIX. But if we highlight that, the less volatility in the marketplace overall, we're also seeing that in the FANG stocks. So going into earnings, for example, part of the reason why we picked the strategy that we did today for the stock play of the day, we see that Apple right now, via their chain, is showing an expected move of around 4%. Now, if we go out and look at a 5-year average of what Apple has moved after earnings announcements, it's up around 4.6%. So you think about that as an average, and to see Apple trading with their option prices expecting a move around 4%, that's quite a bit lower than what a 5-year average is. So not only is the marketplace settling in, also Apple is going into earnings, and we're seeing those same type of numbers on the other companies that are going to be announcing this week. Google, Facebook, Amazon, they're all a little bit under their average move after an earnings announcement in general. So by looking at all the FANG stocks and all the ones that we've talked about, one of the more interesting chart patterns that we see in the FANG stocks is Apple. Apple has basically been dead in the water for the last couple of months. And we see they hit their new high back in February, if I'm highlighting it here on my chart. And back in February, it got up to 145, but just for a second, and then came dropping precipitously down, all the way down to a below 120, right around 117 was the low since they hit their high. So I'm going to highlight something here. This is actually called a cup and handle. And I'm just going to draw it freehand here, but we have a lot of consolidation through the month of March, and we finally have a little bit of a breakout here going into April. Now, to make a cup and handle pattern a little bit stronger, you want this little bottom of the cup to be long. You want a wide cup if you can. We had the month of March. It's not bad, but it is ideally the longer that pattern, the longer that it just kind of hangs out trying to decide which direction it's going to go, the better for this pattern overall. Now, ultimately, earnings are really going to be what drives the stock price forward. But ideally, you'd rather have a better chart pattern than a good chart pattern than a bad chart pattern overall. So what we're seeing here is a little bit of a formation in a cup and handle. A lot of times people will think of it as a head and shoulders type scenario too. A lot of times they'll get mistaken or basically addressed the same way. To me, this looks more like a cup and handle than anything overall. So as always, when we look at the strategy here on the stock play of the day, it's not meant to be a recommendation. But because we see this chart pattern, we decided to go with a back spread with calls. So here's the two things that we've mentioned. We have volatilities coming in general on the entire marketplace, but in particular, going into earnings on the FANG stocks. So we're expecting more volatility as opposed to less volatility. One of the trades that you can do when you have that expectation is called a long straddle, which I'm pointing to here inside the options playbook, or a long strangle, which last week we talked about a long strangle in Coinbase, COIN was the symbol. that trade has kind of been playing out. It's been playing out fairly well, but overall, we had the same type of expectations in coin as we are having in the FANG stocks right now, and that we expected more volatility as opposed to less. Now, we have an earnings report, which we expect will create volatility. So how can we play that without the major concerns that we have about a decrease in implied volatility after earnings, i.e. a volatility crunch? One of the strategies that can do that is a back spread with calls. And this is an alternative to a long straddle where you're buying the put and buying the call. What we're actually doing here is we're selling a in the money call option, which is represented here in the options playbook by strike A, to pay for 2 at the money call options. All right. So you're paying a lot of juice for these option contracts, but your expectation is that the market will move more than what the expected move is. And as I mentioned, Apple is looking for about a 4% move. That's about 5.5 points. So if we think after earnings, Apple can move more than that, and it's no regard to direction. If it goes up, that's great. If it goes down, that's okay too. Ideally, we're going to lean to the upside. So with that said, you could do this to the downside. All you got to do is switch it up and not look at calls, look at puts. And this is the way the profit and loss graph would look. This would be the back spread with puts if you wanted to be bearish on the trade. All right, so once again, we're going to stay bullish. So let's take a peek at the Ally Invest option chains. And we've got a little bit advanced here the last couple of shows here on the stock play of the day. But earnings are when I think advanced trades are more relative and where you want to try to protect yourself by maybe adding a leg to your strategy as opposed to doing it just buying a call outright or maybe doing a spread. Here we're going to actually do what's called a ratio spread, where we're going to sell one option to try to pay for 2 options to give us a little bit more upside in general on that trade. Okay, so we're going to look at the April 30th expiration to start with, and I'm just going to highlight something here. This isn't the expiration that we're going to use, though. If I look at where Apple is at right now, 134.57. So 134 we'll call the most at the money strike. If we buy that call and we buy that put, you add those together, just kind of look at the ask price here, 310 plus 250, we're talking about $5.50 approximately, pushing on $6 overall. So if we take the midpoint, we're right in that range. Okay, so that's the expected move by that short expiration. Now, with a back spread, we would like to have more time for the trade to play out. Time is our friend here. So we're going to go out one more expiration. Why? Because we can. Because we can get this done for a decent net credit to the account. And we're going to put the trade on with the expectation that we're going to move more. We don't care if it's to the upside or the downside, just as long as it picks a direction and it goes. So for example, here, we're going to be buying the May 7th expiration, 10 days to go here. We're going to be buying the 134 strike call. This is going to drive our strategy. We're going to buy 2 of them. They're very expensive options because we're talking about high implied volatility because of this anticipated earnings report. We're also going to sell the in the money option, the 128 strike call, very expensive option contract. That is, in this instance, we're talking 6 points is the width of the spread. So you're going to have that type of risk. And if the underlying market stays right at 134 after we put this on, that's where your biggest risk is that you get no movement whatsoever. And this is highlighted by looking at our profit and loss graph overall. So right now, this entire trade is done for a net credit of 30 cents to the account. So let's sum this up. So if I put on this trade and the market goes up more than the expected move, we're long one more call option than we're short. We have substantial upside potential. You could say unlimited, ideally, but I don't expect that stock to go to infinity over the next week. But in general, you have unlimited upside potential. If the market does go down, we're incorrect on our forecast, and the market goes down more than the expected move, well, then we can make this net credit. Net credit right now is 25 cents at that midpoint. But I'd rather make 25 cents than lose the maximum on the trade, which would be that $6 overall. So if we get to move to the upside or the downside, we're okay. Upside would be better. And that's highlighted once again in the profit and loss graph. So here is the Ally Invest profit and loss graph. We see right now the colored line is highlighting what our profit and loss is looking like. If we get a move to the upside, it's better that it happens sooner rather than later, because we are long to at the money option contracts. Time decay is going to be an issue, and also volatility crunch is going to be an issue. If we get it to the downside, one of the things that you want to note here is that if the market moves right away to the downside, you need some time decay, because now you want all these options to expire. So you would prefer to have a drop in implied volatility and also a high rate of time decay. We have 10 days for this trade to play out. And ideally, we're going to ride this right through earnings. So on the downside, the more it moves down, you see the colored line eventually starts morphing into the dotted line, which is at expiration. So just keep that in mind, that if it does make the move to the downside, you might not be able to close it right away for basically receiving as much as a premium of the net credit that you received when you actually sold that initial trade. So we're going to officially make this the paper trade. I'm getting a little bit long-winded, but it's a little bit more advanced strategy here. When I put it in the right rail, it's the official paper trade for the stock play of the day. What we're looking to do is sell to open one May 7th, 128 strike call. And at the same time, we're going to buy to open two May 7th, 134 strike calls. Now, this is all entered as one unit down to the trading floor for a net debit or credit to the account. In this instance, we see the net credit at 128. Let's call it 130. We'll make that the price. That's where we try to work the trade. The options are very liquid right now, especially, first of all, it's Apple. And then second of all, we have an earnings. So there's a lot of volume that's coming into Apple. And if we do this trade for a net credit of 30 cents, our maximum risk is the width between the strikes, which is $6, minus that 30 cents brought in, or $5.70. If Apple skyrockets to the upside, we have substantial upside potential. If it goes to the downside, if it does, we hope that it moves at least that expected move, 6 points, or maybe a little bit more. And then our maximum gain would be 30 cents. Now, if we put on this trade and the stock does not move, it stays right where it's at, you want to get out as soon as possible. So here's the valley of death of the back spread. If I go on in and I change this, let's go down to 2 days remaining to expiration. All of a sudden you see that colored line morphing in, and then you decrease some implied volatility, which is usually expected after earnings, and it's going to become even closer. So if they announce earnings and they're staying somewhere within this range, you just close it and get out. You want to get out sooner rather than later, and you want to basically try to reduce your loss as much as possible, knowing that the only way that you can lose the entire amount is at expiration. It goes out right at your 134 strike price. There's no more time premium left overall. So kind of hard to lose the maximum if you think of it that way, but you still want to make sure that if they announce earnings and the stock does not move at least the expected move, you want to try to get out of the trade sooner rather than later overall. But we'll be back on Friday to talk about what we might want to do with this trade, because it's going to live past this Friday expiration. And also Friday we'll know what happened with Apple's earnings overall. All right. So questions. I'm sure we got quite a few with the advanced strategy today. Anything that we'd like to talk about, Callie?
Yeah, definitely. Well, I'm going to point out that Rainbow Robman was the first chat in the chat box, and Rainbow said, I came here for some secret stock nobody has heard of, and I get Apple during earnings week. Well, Rainbow, we switched it up on you because we're giving you that super secret options trade. We never talk about back spreads on stock play of the day. So I hope that's enough to make up for the fact that we're talking about Apple. And I got to admit, I mean, it's a pretty exciting trade. And from a fundamental perspective too, Brian pointed out the fact that options aren't really pricing in a lot of movement in the FANG stocks, especially Apple, for earnings reports coming up. Apple especially is a volatile stock around earnings. Over the past 5 years, Apple has moved an average of 4.6% around earnings, or the day after it reports earnings. And we expect there to be more movement this time around too, just because expectations are so high and Apple has kind of surprised to the downside in its past two earnings reports. So it's exciting, even though it's not a super secret small stock rainbow. But then again, I'm very biased there. All right. Excuse me. Allergies still bothering me.
All right.
Okay.
And then I just want to toss in too, if you have that secret stock, I think you need to share it with us overall. I wouldn't
Yeah.
mind knowing that information, right?
Yeah. Drop it in the chat. Drop it in the chat. All right. All right. So we have a longtime caller Wayne in here for two questions for me, it looks like. So Wayne says, "Hey Brian." Hey Wayne. And he says, "Callie, this week I have two questions for you. What does it mean when a company is trading at X number of times its earnings?" So that's question one. And then question two is, "And if I'm looking at different sectors' performance to find potential stocks that will continue to rally, should I look at the 1 year, 1 month, or 1 week timeframes for predicting more potential growth?" All right, two very good questions, Wayne, and I'm feeling the love. Few questions for me. All right, so what does it mean when a company is trading X times its earnings? So Wayne, that is the price to earnings ratio. It's basically a way to value how expensive or cheap a stock is compared to its earnings. So I'll give you an example, and this is just hypothetical. But let's say that you have a stock that's trading at $400 per share, and over the past 4 quarters, let's say, it's made about $20 in earnings per share. So if you take the price, which is 400, and divide it by the earnings, which is 20, you would get a PE of around 20, PE, price to earnings ratio. That's a good way of comparing it to another stock. You could say that, okay, well, stock A trading at a 20 PE compared to stock B in the same industry, which is trading at a 15 PE, then based on the PE ratios, then, maybe stock B has a little more potential because its PE ratio is lower. It's a little cheaper compared to its earnings. That shows that the denominator in the PE ratio is high relative to the numerator. So, based on PE ratios, if the market were to realize that those earnings in stock B, we could see that PE ratio or that price move up a little higher. That's really technical. And I'd argue while valuations are important, they're a little tough to judge right now, just because, things are still a little weird in the market. The 10-year yield is around 1.5%, and that makes stocks, a little more valuable relative to bonds, just because bonds are so overbought and rates are so low. So valuations are a good way to look at individual stocks relative to like sectors. They're also good to look at for the overall market. You could run like the S&P 500's PE, but I'd argue that it's a little less important these days. So that's question one. And then question two, that's a tough one, Wayne. I am not the chartist in this show. That's more Brian. But, if you want to look at, sectors with potential momentum or stocks with potential momentum, you want to look on a shorter time frame, because that's where the technicals really come into play. So the 1 week or the 1 month time frame could be more important than the 1 year time frame. But that's the way that I view it, and I'm not the technician. So I'm going to pass it to Brian and see what he thinks about that.
Yeah, I'll take a crack at the timeframes. If you talk to a lot of chartists overall, they'll give you the canned answer that all the timeframes are important. Now, if I'm looking at a weekly chart, I really like to look at, or a monthly chart. You just want to look at what's happening at the end of the week or at the end of the month and see what type of bar, if you're using candlesticks, has formed and what that says to the duration or that stock overall. Some people will say on a longer term basis, you might want to look at a longer term chart. On a short term basis, like we're looking at right now, we're looking at the daily time frame, and we're going out about 3 months. And that's partly because the pattern that we looked at was the consolidation of the cup and handle lasted about a month on a daily basis, and it kind of hung out there before it started to form its handle overall. So all of the time frames a chartist will say in general are important. But if you're looking at a shorter term move like we are today, this is a very speculative trade. We're only doing it because of Apple's earnings. Ideally, we would probably not do this strategy if Apple wasn't announcing earnings overall. Then we're going to look at a shorter time frame. But if you're looking at the market overall, a lot of people will like to look at, and you're thinking about a longer term outlook, well, then use a longer term chart. And in general, all the time periods have something to say, and it's useful to look at each different time period and look for anomalies or things that you see overall when you're doing charts.
Good answer, Brian. And that's why we have a chartist on the call. All right.
I won't call myself a chartist, but an amateur chartist. Let's say that.
Don't sell yourself short, Brian. All right. So it looks like there aren't any other questions. I'll give it one last call for questions. If anybody has any questions for us, we're happy to answer. Don't make them too hard. It's a Tuesday morning, Tuesday afternoon. Our brains are still trying to, kick it out for the big week. All right.
All right. I think that's going to be it for today's show. We're coming up on time.
Yeah. So I'll go ahead and close it out. Thank you for joining us, everybody. Like Brian said, every Friday we revisit these options trades. So come and join us for Stock Play of the Day Overtime at 12 p.m. Eastern every Friday here on Ally's YouTube channel. And I'll let Brian send it off.
All right, everyone. So to make sure you get all the reminders, you want to click subscribe and you want to ring the bell. And we'll see you this Friday on the Stock Play of the Day Overtime edition to see what happened with the Apple trade after the earnings announcement. Thanks for coming, everyone.